Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings. Thank you so much for joining us. This is Macro to Micro Options Power Hour. I was just joking. I said, Hans, you got a shirt on. I haven't even blow dried my hair for you. So we're very casual today, but we're clean.
Summer.
Okay.
It's a summer look, right?
It's the summer look. Absolutely.
You just
Summer
got out
breezy.
of the pool. You were just in the pool. I was just, all right.
Awesome. Well, it's been a few weeks, so we really have lots to catch up on. I had my European vacation, 3 countries. It was very busy. I hope you took some time off. We had the 4th of July, your Canada Day. Long story short, we have been MIA, but we got through basically the big event, which was just before we left. We talked about how war reprices everything or changes everything or what have you. Luckily, we had 3 options that I wrote about, and 2 of them were bullish. One was bearish. The one that was bearish obviously did not materialize. June 23rd, we gapped down. There was a truce between Iran and Israel. The bunker bombing display, we'll call it that, was basically the end for now. So who knows what will happen. But long story short, the market rejoiced. We had those bullish options bets of melt up into meltdown. But obviously, macro event risk can interrupt the bullish flows. When we had the truce, one of the 3, truce, true regime change, or troops. And luckily, we had the truce. So we're basically in this kind of melt up feel. People are a little nervous about it. But as we said last time, this is kind of the MO for the market. And as I remind clients, you don't short all-time highs or buy all-time lows. You wait for a macro trigger and or a pattern and or bearish flows selling underneath the surface. And so far, we have not seen it. Now, probably we come to you this Wednesday afternoon and it'll start right now because we're, but as of this writing, we definitely have had a backdrop of more, including the OBBB, big, beautiful, big, bad bill, however you want to put it. But basically it passed and that creates this backdrop of all gas, no brakes. And so this fiscal stimulus combined with geopolitical de-escalation, combined with seasonally bullish flows. I mean, when we talked about this, when is June bearish? When is July also in NASDAQ bearish before the 14th? It isn't, seasonally speaking. Last year, we actually had July 19th cap it, and then we rolled over. But that was, again, a macro trigger. It was the yen carry trade unwind. Yields in Japan are definitely spiking higher. U.S. yields are stable. The dollar is down a good 11% from its peak, but it's in an area of potential support. I would also contend bounce before the trounce. But for right now, this de-dollarization combined with fiscal, combined with bullish flows, et cetera, and Trump getting his bill passed on July 4th has basically been an all clear for traders and investors alike. So anyway, I wanted to turn it over to you. Catch me up. That's what I obviously kind of came back and got my sea legs and did 2 client posts, a big one Monday, another one last night. So the trading has been a little choppy intraday, but the trend is still intact. What do you see, Hans? Oh, by the way, I'm Samantha LaDuc, founder of LaDucTrading.com, and this is Hans Albrecht, our options mentor extraordinaire, and that's actually how it looks in his Slack channel for our LaDuc Trading members. All right, now catch me up. What happened while I was away?
I don't think you guys put the word extraordinaire in there, and I'm a little hurt by that. It just
That's an
says
oversight.
Hans.
We'll fix that.
Okay, good. Look, you missed more of the same over the last few weeks, and I'm sure you took a peek every now and then because I know you too well, trying to keep in touch with what's happening. And sure enough, we've been talking about this melt up, and of course, it's been something that I've been talking about, that we've been talking about for quite a number of weeks now, just saying, look, people are a little bit offside, and the market certainly seems to want to shrug off just about every piece of news that you can throw at it. And somebody sort of talked about it. I think it was somebody at RBC yesterday or the day before, and they called it Schrodinger's tariffs. And so if anyone knows this Schrodinger's cat, it's this sort of thought exercise. It's like quantum-y. Basically, you put a cat in a box and you put some poison in there and you close the box. And then there's this notion that the cat can be both alive and dead at the same time until you look inside. It's just completely mind-blowing thing. But the idea, we've kind of joked about it. Can the cat be in the box? Can be outside of the box at the same time? So the tariffs are sort of playing this kind of, are they alive? Are they dead? Maybe they're alive. They may be alive, but the market seems to want to lean a little bit half full and sort of say, well, maybe they're alive, but they don't matter anymore. And I think Trump keeps sort of playing the card that is contributing to the market saying, you know what? We've sort sort of seen this too many times now. We're going to delay it. We're going to kick the can down the road. And when I see can kicking, to me, that isn't a sign of I want to kick the can down the road so that I can kick you in the teeth later on. It's let's talk. Let's do something. Please call me. He likes to talk about how, oh, everybody's clamoring to talk to me. I think he's kind of going, please call me and let's discuss something and let's make a deal. And so I think the market's just kind of catching on to that. So you can kind of almost see this sort of less and less abrupt flinch every time the word tariff is mentioned, and we just keep shrugging it off. And then in the meantime, of course, we are not going to go an episode without talking about AI. We'll guarantee you that, because of course we see the market being led by by the big names that we know all too well. And when you look at some of the leveraged AUM growth, so you and I talk about synthetic gamma and real gamma from options, from dealers being long options or short options, and we see the levered AUM, so the SOXLs, the MSTXs, MSTUs, these products that are sort of 2-time, 3-time levered, we are now at all-time highs again. So we saw that drawdown in April to lower levels, but still significantly higher than anywhere we've been in the last 4 or 5 years. So it was a little bit of a drawdown. Now we have come all the way back up. Retail continues to be interested in these products, and that contributes to that upward synthetic gamma, because when we have consistent moves, especially larger moves, these sort of swap products have to basically reposition, and we call that rebalancing. So they have to buy into big rallies, they have to sell into big sell-offs, which absolutely contributed to the sell-off that we saw. So this is a two-edged sword. This works both ways. But in the last couple of months, it's just really been one way in particular, and it's contributing to that consistent bid. Now, on top of that, we have our usual suspects in the vol targeting space. You've talked about Nomura and some of your notes to members and some of your public notes, which everyone should read. If you are not reading Samantha's Substack, you are in the dark. So fantastic points that you're making. You talked about this a little bit, how there is this sort of consistent bid in the market from these systematic products, right? So we always talk about how there's retail, there's institutional, and then there's this whole kind of murky world living in the weeds of these systematic funds that at the moment need to buy. When the market's quiet, they need to buy. When the market's up a little bit, they need to buy more. When the market's up significantly, they need to buy more. So there are charts that kind of show as realized volatility, which just means movement. It's a fancy word for how much is the market moving. As it moves less and less, and we have seen this market absolutely kind of crawl to a stop from a back and forth standpoint. That doesn't mean we haven't gone from 5,900 to 6,200 or whatever it is, but it means that it's very, very measured and steady and very few dips in between. And that means realized movement compresses, and that means these funds say, oh, gotta buy some more. And so it will continue to be so until things do somehow, we get that macro event, whatever it is that you're going to talk about potentially could happen, and then the snowball can start going down the hill again. But until that happens, it's going to be the same old, same old. And like you said, that just makes life awfully difficult for the bears.
It does. And we kind of summarize some of those bullish, mechanical, systematic flows, price insensitive systematic flows. We really need macro triggers to interrupt, but the problem is they're getting pushed out. So they're just rolling out the deadlines for the tariffs, and passing of the bill pushes out. Now TGA will refill, which is Treasury General Account, and there's going to be a flow of liquidity that can actually create the triggers for buying begets buying. Anyway, some of the data on that. You've got Nomura out projecting a hefty amount of quants buying the market. This was a June post for July. 1 month buying that they are expecting to be the largest since 2004. And you've got Goldman out talking about implied moves.
100th percentile, Samantha. 100th percentile. Just absolutely massive buying.
Yeah. And then all the way through to July FOMC meeting, which happens to be on the 30th. And then August 1st, you've got some payroll data and ISM. Also, the deadlines are supposed to kick in. Goldman says we also see CTAs have another 95 billion of US equities to buy, even in a flat market. So that's some of the mechanical buying, but obviously there's also folks that got a little busy. The North American, active investors, they did increase their allocations. When I was gone, it was at 82%. Now it's jumped to 99% on my return. So they got a little bit busy too. So there are also funds that are coming in. But for sure, this, and I wrote about it, the Trump tariffs getting pushed out, and then a little surprise headline risk came in, and the market jittered a little bit, wobbled a little bit when they said, okay, 25% on Japan, and also on Korea, who doesn't even levy tariffs on us. So that was like, okay, there are some strange things going on. And then the 50% increase on copper. Again, we use it in everything. And that's going to be borne by the companies in the US as well as consumers. So there is a strategy of chaos that we have not quite unpacked, but oftentimes the taco theme does ring true because he unwinds these threatened 50% import levies on copper and or on Japan. So we haven't even gotten through Canada. You're coming up. This is the 12th. Hans is over on the other side of the border, and that negotiation is on the 12th. Still looking for the EU. And then, of course, China is coming up on the 1st, August 1st. So we still have these triggers of headline risk. There is no question about that. But we also have breadth that has expanded very nicely. So for my intermarket assessment, which I have stayed on, as long as the breadth is continuing to expand, that's a sign of strength. And right before I came back, I think I looked into the market. Yes. And I could see underneath the 6 days of panic buying underneath the surface. So as soon as the truce hit, we definitely got very strong buying underneath the surface. And I'm talking about the truce, Iran, Israel. So another thing that has been very, very helpful is credit spreads. I talked about this as well. As long as they're falling, it's very supportive to equities. And I will show you that chart. And as long as VIX is falling, it's very, very supportive to equities as well. So this is high yield OAS. This is when I warned that this was about ready to spike higher, and we had that fall from February into April. This moved over 200 basis points. We're right back down into the level where we broke out higher. That's credit spreads. As they're falling, it's very supportive for equities. This is the volatility. Well, I don't have to show you a VIX chart, but my point is, obviously, it has fallen into the July seasonal low. And this is something we're going to talk about because I can see Rish is asking a question about what about hedges? So this is something.
What are these hedges? What are you mean the things that you trim in your garden?
No, I mean
those are important.
The ones that the hedges only cost money. So, but they are important nonetheless. You know this. We're getting into July seasonality lows for VIX. This is when folks will start to come in, and you will start to see September and October get loaded with protection.
We quietly see the VIX start to march up. People are sort of sunning themselves, and the next thing they know, the VIX is starting to make its usual seasonal march up.
And what was my level before I said I did not see any volatility before? What was the number?
15 and a half.
1550. We're almost there. We tagged 15 just today. We went just below it, then popped right back up. I still see it. So, Rish, it's a really, really good time to hedge once we hit that level. Does not mean we're not going to melt up, though. So this is the problem. We can actually ignore the seasonally strong VIX issue if we have this melt up thesis kick in. And right now, unless we come back and break 6147 and stay below, which is our breakout of the prior high, then unfortunately, full speed ahead. And why I say unfortunately is because it's much better to back and fill. Boring is profitable. When you have a melt up scenario, it only creates instability. It only creates a much higher probability of a massive blow off top. So, yeah.
That's the interesting thing. I have to say, I maybe got it just a little bit wrong just in the last week or so. I mean, I still believe in the sort of slow melt up, but I thought maybe the VIX would kind of hang in there because what I started to see was some, particularly in single name, some of those shorter term option pricing measures kind of start to push up a little bit because we sort of went from 600 to 625 fairly quickly. And it was starting to play out as one of these things that we've seen a number of times since last July, August, which has been this sort of spot up, vol up. And so when I think it's always interesting to revisit for folks who are interested in volatility and of course options trading, because if you're an options trader, you are a volatility trader, you are a sentiment trader, you are trading fear, greed, and everything in between. So you want to know about this stuff. It is important. So what we see sometimes is when stocks in particular start to get parabolic, and it could be anything. It used to be just the MSTRs, but it has become in the last year, we've seen it happen even in very, very big companies where the stock just relentlessly goes up and eventually option pricing says, hold on a sec. I don't know where this is going to end. Is this going to end up being a ridiculous parabola? And then it starts to think, well, the higher they go, the harder they can fall potentially. So what option markets start to do is they say, well, we're going to just step back and start charging a whole lot more for this potential powder keg of parabolas or retests because of a parabola. And so it kind of stands in there. And I said, well, listen, we're going to probably stay up here until the market pulls back. If the SPY pulls back to 615, 616, then we'll see volatility relax relax. And that's what's happened. So I wasn't wrong for very long. That's exactly what I
No,
said would
and
happen. As soon as that's what happens. You get market up, vol up, which is weird,
yeah.
right? Because when the market goes up, VIX is supposed to go down, but not when things get a little too exuberant. That's when vol markets go, hold on, what's going on here?
Have you noticed the past few days, because I'm running the trading room again, VIX has been down and SPY has been down, or we had a little
Yeah.
bit of spot up, vol up too, but it's like, anyway, it does not mean 1550, by the way, is the low. 1550 is simply my technical analysis on VIX of where we were going to fall from that April to May to June. It didn't take place by June. And then I said, okay, let's do July. Like it's timing, it's not there yet. It does not mean we can't bust through that and go back into 14. It doesn't even mean we can't go down, and we had 10 long time ago, but it's less likely in my book anyway.
Exactly. And that's what happens, Samantha. So when the market is relatively relentless to the upside, whether it's a stock or an index, vol sort of stays up there. And then when you kind of find a level, what volatility says is it says, oh, you found a level, 625 or whatever the level is. Oh, you found a level where we found some sellers, we found some willingness to kind of step in the way. Then vol pulls back. So that's what you're seeing, is you're seeing a little pullback in the market slightly, as well as a drop in VIX, because from volatility's perspective, it says, we found a place of comfort where we can spend some time. And that's where people start hammering vol. They say, okay, parabolas are off the table, at least for a moment. Let's hammer vol for another week until we start getting close to some event, right? So we're getting these periods, which we've seen quite in a pronounced way over the last year, which is we get these pockets of options just getting absolutely hammered because people are saying, listen, nothing is going to happen for the next 10 days. And they're often right. But then we start repricing the next event. So it's feast or famine. It's very much, I was explaining this to somebody the other day and I said, listen, I've been doing this since mid to late 90s. And I remember when you weren't able to take a breath in some periods. You would go 2 weeks with every single day being breakneck volatility. And that could go for months. It was exhausting. Now you get more volatility clustering, which is either all hell's breaking loose like April or nothing's going on. You can't even get a downtick. And it's just these periods of feast or famine are very much being played by option sellers. So they're hammering options right now. That does not mean the VIX cannot rise from here. So it's a good call in the 15s. I think if any lower than that starts to get a little bit too cheap, because yes, we're going into slower, hot summer months, but we start to approach that seasonal period. We start to approach some of these Trump dates. We start to approach other things that could potentially rattle markets, break the currencies. I mean, the yields are behaving, which I think is helping right now.
So the yields are stable, CPI is stable, employment is stable, corporate earnings are stable. You take any of those and muck them up, then we're going to have some more volatility. And that's what we don't have right now. So we're waiting for earnings, which kick off next week, especially bank earnings. We'll see if there's any slowdown in lending. We'll see on the aggregate if it's hard to have earnings actually on the aggregate fall because they just ratchet lower the earnings expectations so they can beat and raise. That's the game we have to play along. But the point is there is stabilization on these numbers. If you believe them, that's not my game. It's just there is stabilization. We start moving higher in jobless claims. So that's absolutely going to be a trigger. That's very hard for the administration to control. Right now, they are projecting from this OBBB. Kevin Hassett was out in this Sunday touting 3% per annum growth for 10 years, which is hard to do. But that's his model and he's sticking to it. And that's the rah-rah call. So that's why the market's also excited. Tax cuts are passed on and they're not looking at anything bad. So melt up is priced in, not melt down. But one thing I wanted to show you and get your thoughts on is this. So, I've done this chart many times before. So for anyone who is recurring here, you'll know this is growth value rotation and it's kind of kludgy, but just bear with me. It is something I look at every single bloody day. And the reason why I kind of highlight it is you've got this situation where growth value, this was all Nvidia, very big move May of 2023. And then we actually topped out. I was doing a macro to micro power hour with Craig on this July 19th. And we literally topped out right here. And we had the yen carry trade. It was very extended. All right. So the yen carry trade unwind of last year. And you came in. That's right. You covered for me that week. I was on vacation. So much happens when I'm on vacation. Anyway, and then we had this Trump Trump bump. You can see it right here. Very, very strong growth rotation. We formed actually a perfect head and shoulders right here for anyone who's into technical analysis. But the point is, it gets extended and then it crashes. This was a head and shoulders, and that was basically the Trump bump was unwound for reasons related to tariffs, etc. So then, of course, the announcement of tariffs, you've got the selling under the surface came in basically in February when I warned, and then we had the announcement of tariffs. Anyway, long story short, we had the intervention April 9th, very, very, very important, formed another little inverse head and shoulder of size, and we've been moving higher in
Double
growth.
bottom there. I mean, perfect
It's
tag
gorgeous.
of that earlier level. Beautiful.
But this is what I have been waiting for, right? So, and clients know this. It's this level right here. Again, it's kind of a kludgy chart, but bear with me because that would make a really nice, long story short, you kind of got this left shoulder, you got this head, and then you got a right shoulder. So whether or not we get it is another thing. In other words, get it? Yes, I think we're going to melt up and then pull back because it's going to be too extended. That's kind of like my vibe of how I'm looking at this chart. The problem is the timing of this. It looks like it's ready to go. Like maybe earnings will be a very, very hot deal. Anyway, I'm just kind of looking for, first and foremost, this growth to value is still in play. Growth coming up back into this area where we had it before, and then we'll see what happens. But more importantly, what does that do to VIX? The whole reason I'm going through this mantra is to say, what about VIX? If it's going to hit my 1550 area, and yet that melt up isn't done.
Yeah. So look, I think it stays in there because if we truly do get the melt up, which is I've been talking about it and I think it continues. And I think the market is becoming a bit emboldened. We can tell that there's an underlying bid. Now, whether it's from institutions not having gotten in, they were all out. This is one of the least participated rallies that I've seen in many, many, many years. From the data, we can see that it really took a while. Retail was the smart money. Retail's been buying all the way up. And then the smart money has had to say, well, listen, we're going to put in some terrible performances if we don't get on board here. So we've seen some of that come back in up to about 6,000, 6,100. So we did see some of the smarter money kind of replenish their allocations a little bit. Now, if the market melts up, then I think we actually see a bid in VIX, as we were sort of talking about a moment ago. And I don't see it getting a whole lot lower than really where it is at this point, because it has to start to account for movement. Upside movement is still movement. So if the upside movement becomes somewhat violent, then that's going to be reflected. And so, as you know, I've been looking at, I want to show you guys a couple things, but I've been looking at, this has sort of been one of my indicators. I think the market has been emboldened by this next phase of AI. I know it sounds like this broken record, but it's been a profitable broken record. It's been music to my wallet. So I'm going to continue to push it because I think it's a bubble inflating in some areas, right? I don't think it's a bubble in Amazon. I mean, look, even Mag will get expensive at some point, but I don't think Nvidia is expensive. So I've been screaming about buying this since 117, 120. I was very uncertain around 110, 105. And that's how you have to be as a trader. I was thinking things are not looking very good. And then around 117, I said, no, this is changing. I can see this inference phase start to begin. And this is going to be extremely different. There's going to be something that requires much more compute. It's going to continue to require, that's what's rejuvenated the chip makers. You can see the SOX is straight up. And I've been getting members into things like SOXL. I'm up like 400% on some of these calls that I bought. And people said, you're crazy. Why are you buying calls on SOXL? And I said, well, I don't often do that. And I've actually started to do it on MSTX. And if you notice, MSTR is starting to go for run Bitcoin, maybe breaking out. And so there's a time and a place for certain kinds of these crazy instruments. And I think you can see the silly money. Let me show you this chart that I mentioned, I don't know how long ago, but I pretty much mentioned it all the time. Oh, here's my Schrodinger's cat. Schrodinger's cat, I was starting to write in Schrodinger's tariffs. But anyway, so here's here's the gas and the cat is, I don't know. It's crazy, quantum craziness. Well, hold on. Let me show you something different first. This is my VIX 9-day to VIX. So if VIX gets down to 0.7, I'd say you have to start worrying about a pullback. I don't know how deep of a pullback, but this starts to get into that complacent part of this relationship. You can almost think of this as like a term structure getting too steep. When the VIX futures curve gets just too steep and everything's just too blue skies, then you start to worry that maybe the market is, generally when that happens, you see realized volatility drop into the teens. So you see like 7, 8, 9, sometimes even 6, and the VIX will not drop. So when you guys see VIX refuse to drop with 10 to 20 day realized volatility, if you're watching charts like that in the 6 or 7 range, that is a time to start being very, very careful, at least from a short-term standpoint. I will admit, you guys know I'm generally bullish, but I will admit that there's a point where you kind of need to be a little bit more careful. So this is something I talked about a while ago in here, and I said, Samantha, I'm in the silly money trades. I have some ARC calls. I've got some of these silly fast money. This is kind of your chart of the fast money part of tech, although it has Tesla and some things. Sometimes I wonder if I should be measuring against something else. But here, basically, when it's going up, it's the relationship of ARC versus big cap tech. So silly money is going in, silly money is coming out versus big cap. Silly money is coming out versus big cap. Silly money is going in to ARC versus big cap. And at this point here, this inference phase was starting to really take off as a narrative. And I said, I'm not getting out of these things until we get to this red line, which we did. We got there, we went a little past. And now what I think is interesting, and this is playing out exactly as I've been talking about, which is basically we hit this, we went a little farther than I thought. You can never nail that to a T, but I said, listen, it's going to come back down. And that's when you want to start looking for it, watching it. Because when this relationship comes back down, this means that people are, remember, it's a relationship. It could mean that people are pushing into the big cap a little more, not necessarily selling the ARC type stuff. But regardless, you want to see this kind of consolidate a little bit, and boom, look what it's doing today. It's making a little push up. We see Bitcoin starting to break out. We see MSTR starting to go a little bit, which is, I've been buying some speculative options on MSTX because I think those could be quite an interesting play, a little bit longer term, right? I want to give myself some time. And if this starts going and starts breaking this red line and making new highs, then we're on again, right? That means silly season continues. So if I bring up ARC, you can see that it's starting to break out again, right? Got to 70 and now it's starting to go. So what's kind of interesting to me is that if we truly get into a melt up, what I would want to put in people's minds is I've been through these where you go, how can they go further? How can this keep going? And they do, and they do, and they do, and they do. Let's look at a 5-year version of this chart we were just looking at. Do not discount things getting Looney Tunes. So look at this. We have come down, Kathy Woods.
You sound so giddy with excitement.
I love this stuff. I get excited about this stuff because I love speculative bubbles because there's so much bloody money to be made.
I don't like the blood that comes after.
Right. There's going to be blood. Exactly. But what I love about them is they underprice upside. So one of the greatest parts of a silly Looney Tunes rally is that everyone thinks it's not happening, that it's not going to continue, that they're going to bet against it, that they're hammering out calls, and the upside becomes very, very cheap. And so I'm looking at some option pricing and particularly upside skew in some of these names. And I've been talking about that on Nvidia for like 30 points now. I said, listen, the upside
Nvidia is not a micro crap. I mean, it is a $4 trillion tech mega cap, golden child, semi player. It's not going the way of ARC. ARC is a bottom fishing play. But
it feeds that whole world, Samantha. This is you will not believe, in a few years, we won't believe how much data we're creating from sensors. We'll have sensors under our chairs watching us every step we take, everywhere we go. There'll be sensors. Okay,
now I'm worried.
Now I'm worried. Well, Sam Altman said it the other day. He said, I'm going to be with you everywhere at all times. I'm paraphrasing a little bit, but it was really, really creepy. I was like,
will not join a club that invites me kind of vibe right now. So hold on.
Just look, one last thing. Look at this chart. So here's your relationship going back through all these tops. Why not? I'm not saying this was reasonable, but I'm saying that if we get into a Looney Tunes season, be very careful. Don't get your face ripped off shorting.
Okay, but we have to get there first. And let's go back to 2021, which was the Looney Tunes season, right? When this massive SPAC implosion, the K-Web Chinese ADR implosions, the GameStop implosion, which, by the way, I knew I had that way in advance. That was my $4 to $40 stock, and it went to $340. So yes, I know this season as well. And also, this is when you get trouble, when you get this factor rotation where they start to cover these shorts like the ARC, kind of the garbage stuff, then you really actually have volatility coming in later of size. We're not there yet, but that's always a precursor to volatility. Let me just show you one good little reference. So what you're talking about right now is relative performance from this. These are mine, little shapes on here to kind of identify that since the April 9th policy intervention of Trump pushing out these tariffs, right, to July 9th, and now it's August 1st, you had tech outperformance, and tech's a big basket for all the reasons that you're giddy about. And then you had really flat as it relates to the rest, discretionary, industrials, communication. Financials did well, but the point is energy, utilities, staples, healthcare, they're just on the floor. And a better representation of that, I think anyway, is when you kind of take a look and you kind of see this type of situation going on where you've got percentage of stocks above the 200-day moving average, right? Nothing good happens underneath. Then take a look. You can see energy is still languishing terribly with real estate, which is practically in a recession. Nobody's everybody's playing healthcare. The baby bios are popping up because it's factor rotation. Staples are also underneath. What isn't, of course, is stuff related to this AI ecosystem. Look at utilities still powering higher, not to mention tech, etc. So you've got definitely a lot of excitement here. But when I look at ARK, I see it as something a little bit different. All right.
Traditional defensives, your sort of traditional, I mean, utilities maybe don't count so much anymore, but your defensives are really underperforming versus cyclicals. But go ahead.
Huge, huge. We don't have that value rotation of size. We have micro crap like the ARKs and baby bios, whatever. And then we have the mega cap tech behemoth. But this is the ARK, right, that you're talking about. So since April, I'm on a weekly, so keep that in mind. This has done extremely well, and everything gapped up on May 12th. Remember my write-up, May 12th birthday rally? It happens to be every year. I know this. Why? It's my birthday. So I'm like, we're going to rally on May 12th. Anyway, I don't need any historian or farmer's almanac. Just put that in your bookmark right now. We digested beautifully. All charts look like this, by the way, right? This sea of green weekly closes, and here's ARK. What's that red thing right there? That's a monthly. So if I go and kind of like put this on a monthly time frame, this is a huge amount of 2022, 2023, right? 2024, 2025. It's trying, it's making its efforts on a monthly to get up and stay above some really depressed levels. This is also where, by the way, it can get tapped down hard if we don't have your melt up. I just happened to look at that today because I got a trigger right when I came back in. I'm like, ARK's at monthly resistance.
Yeah, I think we'll get to the point where maybe we get a little blow off top here in the short term, because it's not unusual to see that in the sort of lower liquidity summer, and there has been a lot of exuberance lately. But the strength is incredible. And for me, where I've really been positioning hard is in those picks and shovels makers. And I think that's kind of the old gold rush thing, that Nvidias don't necessarily care who makes sense of this inference, but they are going to benefit from the fever, the desire to kind of get on board, whether it's government, private, everywhere, everybody's kind of getting on board. And I think there's going to be data center proliferation. This data that we're going to be creating, it's going to be a data hoarding world. It's going to be an inference world where we're just trying to constantly crunch data. I don't know if that's going to be as much use as people think it is, but it's clearly changing lives. It's clearly bringing productivity gains. I mean, even anecdotally, I've talked to people that I'm finishing things that used to take me 5 days. I'm finishing in a day and a half. There's no question. And so what's interesting to me is that I think this new world, in my view, it's almost kind of this a known unknown. So I don't think everybody's on board like I am, or like, some of the Gerstners and people like that. I mean, I'm buying into that this is really, really big. And when things get that big, fundamentals don't matter as much. I remember the late 90s. I remember periods of craziness, and you hear people saying, oh, the market's expensive. It doesn't really matter if you kind of have this potentially massive tailwind of thinking that, listen, this is going to improve profit margins via productivity, via AI changing things. Forget about the jobs it's going to cost. At some point, that's a problem. But in the meantime, this is going to create something interesting. And so I'd love to have your view on something like this, Samantha, this is from our friend Torsten Slock. I apologize for the resolution here, but basically it's the forward swap, right? It basically bets on where rates are going, which is going down, versus cyclicals versus defensive. So this is the relationship that we were just talking about. Cyclical is doing very well, meaning, okay, the economy is expanding. So this isn't saying anything about the economy slowing down. Is it right? Is it wrong? We're not going to know for a while. But at the same time, why is this disconnect happening? Because they're a little bit in conflict with each other, right? Because either the economy is taking off, and that's going to mean that inflation stays healthy and that rates can't come down too much, or the other way around. So one of these, he's sort of saying, well, one of these is wrong. And I'm postulating that maybe both can be correct, because if we are going into one of these sort of unprecedented periods of, we don't know who's necessarily going to win. Somebody the other day said, I don't know if it was Vinod or one of these other guys, saying, listen, we're going to see S&P disruption to S&P companies like we've never seen. Companies like in big trouble, big companies with big moats that turn into drops of water, into puddles. So it remains to be seen how everyone's going to get overly dramatic. They're going to get overly crazy about this stuff, and they're going to postulate all kinds of things. But I think we can agree that this is going to create positives for people who figure out how to use this stuff, and that is going to translate into profit margins. That's part of the reason I'm really loading up on Goldman. I've had some great trades lately, and I'm continuing to add, because I think that's the kind of business where the smartest guys and gals in the room are going to figure this out. They're going to do things for less money. They're going to cut costs. The deals are coming, the IPO deals, et cetera. As long as the economy doesn't implode, I think that's an area where a great example of how this is going to change an industry, it's going to change companies companies who get on board. So can we have super high growth, maybe to what you were talking about a moment ago, Samantha, which is 3% growth and just consistent growth, a roaring 20s, everything great. But guess what? It comes with low inflation because AI is deflationary. So this is just a everybody wins kind of world. And wouldn't that be nice? We lost you, Samantha.
Okay, sorry. I was laughing. I didn't want to interrupt your flow.
You didn't want to laugh in my face like that. Okay.
I'm dying over here. Okay, so close your screens. Because this right here, Fed expectations and equity markets, is a very macro focused conversation that right now we're not going to have. But here's why. You have got the consensus view that rates are going to careen lower. I do not. I'm not consensus. And actually, we talked about this last time, why I'm firmly in the camp that rates will not careen lower. Number one, I believe the dollar will, but that's all part of the de-dollarization. That's a feature, not a bug of Trump policies. You're talking about the AI, not even a renaissance, right? This earth-shattering advancement, it also has a dark side, from tyranny to joblessness. So we have to balance all of that, and we don't know. So I'm not going to go and project on something I can't see. I can't see that. Now, as it relates to this expectation division, I should say divergence between what the market is pricing in and Fed, forget the Fed. Just try for a minute and just imagine that we don't have actually the ability to price assets. We don't. There's no ability to price assets naturally. There's too much policy intervention. With that, Treasury intervention, the White House, Fed, there's way, way, way too much incentive to run the economy hot. That's why the OBBB passed, right? It is all gas, no brakes. And now what you're talking about is a situation where we now have all growth, no inflation. Color me skeptical. So I know the bulls are going, full bore. And this is why I can see technically, I can see from the intermarket, I can put together the bullish argument. Not that I'm not macro bearish for all kinds of really good reasons, but, and by the way, that's exactly what I did with my write-up of, and I do this for clients, and I don't know if you're a client or not, but when you're talking about how do you support your bullish talking points, I write about them. So, here's Trump tariffs and basically just rolling these constantly, later, bullish flows, mechanical, technical levers, in particular, breadth, which I talk about a lot. I'll show you a chart in particular that Ed from Ned Davis posted. I use this all the time with clients, but the point is we're not even there yet. We're not even into a bullish impulse with this chart. We've only made it up into the bullish impulse. Credit spreads falling, very supportive for a bullish market. Dollar de-dollarization is the reason for the season, in my humble opinion, along with the fiscal spending. Yield curve is right now steepening. Got to be careful about that. This is not something that folks are looking at, and it will upset the apple cart. This is the 10 and 2-year yield curve. I have been on this very, very effectively. I really like rates because I know that they can create, a Goldilocks zone for equities, which we're in right now, and they can also create massive, massive headwinds when it leaves that Goldilocks zone, too high or too low, too hot or too cold. Anyway, I talk about stable earnings, quote unquote, but I will also remind that the majority of earnings growth is coming from the AI ecosystem winners, and the rest are losers. And it's not, okay, I talk about employment and what the levers are for when it starts to pull recession risk forward. Here's an example of the mechanical flows that I posted in LaDucTrading Slack channel for members. Here's an example of the bullish percent index when we got down into the 16 lever, which was the April 7th low before the April 9th policy intervention by Trump to delay the tariffs for 90 days. And then he just did it again this weekend. So again, why sell off if he's going to continue to be Taco Man? But this 65 lever, and I say lever specifically because we can hit this and get rejected. We can go back and kind of backfill, do a little mean reversion in the SPY, and everyone's going to get all freaked out. But the reality is we get and stay above that 65% of S&P stocks above their 200-day. It's very bullish. So I don't know what you mean by I'm not showing my stuff. I'm definitely showing my stuff. So I don't quite understand that particular comment. But we do have some headwinds as well. And I talk about the macro event risks. We've got a dollar that right now is on channel support. Big picture, I still see it moving lower. And that de-dollarization theme makes objects like assets, like equities, appear larger than than they really are. We have grift as far as the eye can see, and it makes me just enormously uncomfortable. But the fact of the matter is, we are in the age of grift. And in lieu of the dollar crashing, they create these off ramps for both inflation and dollar collapse. So people invest in ARK, they invest in crap, whatever it may be. These stable coins are another way to delay the fall of the dollar, or I should say the speed of the dollar. The dollar is going to fall, but the rate of change matters. So they've got all these mechanisms. Oh, what was the other one just recently? I also posted, right? This kind of stuff. What is the Trump family organization doing? You know, filing ETF to launch crypto blue chip ETF. This is all part of the This is all part of the grift. It's the Melania coin, it's the Trump coin, it's all, people are still going to invest in this because it's easy money and conditions are very easy. And Trump, honestly, browbeating Powell to cut when there's no reason to. Trump is also saying we got the best economy ever, we're growing 3%. We don't need to cut. But I know the consensus is, oh yeah, we need to cut. No, really. Powell's going to get replaced with someone dovish, whether it's Bowman, whether it's Kevin Hassett. I don't think it's Kevin Warsh. It's got to be a loyalist. That's all he does. He only employs loyalists. So it's likely going to be Hassett. So basically, it's only going to goose the economy more. That's another melt-up thesis. So I don't think it is an easy question of saying, why are equities higher than Fed expectations? No, that's a useless measure. Why do they keep intervening with policy to keep the market goosed? Why do they keep conditions very, very loose? Why do they encourage grift and financialization? There's no wonder that equities are rising.
Look, that's what they want. And I will, if I take the 75,000 foot view of things, I will become cynical again and say, listen, this is engineering. This is engineering, and it has been for decades now. It's engineering assets to go up, the rich to get richer. And to your points earlier, 100% respect those comments. We are going, at some point, we are going to have unrest. We are going to have problems on the unemployment side. That is going to get rates down. So I truly believe that there's going to be good and bad to all of this. Good is going to be, I think it's going to put a real lid on inflation. I think, like, who's telling me? Somebody's telling me about this new site. I can't remember what it's even called, but I mean, it'll create a website for you. Just like it's some sort of AI. It'll create an app, a website. If you think of how deflationary that is, it's unbelievable. And I remember
I wish I could believe that, but honestly, I have like so many developers and none of this gets done easily. I can't even tie in the futures data for the portfolios. It's ridiculous.
I agree. And it's crap. It's crap right now. There's these things that say, oh, we'll give you this, where it's an AI PDF maker. We'll make your whole PowerPoint. It's all crap. But I wonder what it's going to be like in a year and a half. It's going to get better and better. And
okay, but it's also going to put people out of work, and we have to be cognizant of that. Now, there's a question here that says, what's your take on the bill increasing the debt? It isn't just another 28 trillion. Debt ceiling gets increased, which is giving Bessent a free pass, but it's also the interest so on that debt. So that's why they're trying to force rate cuts. Trump administration is beating up, and I do mean beating up Powell. I had a client actually said it wouldn't be surprising at all if this guy does turn in his resignation early because he's getting just pulverized. Anyway,
I would be letting Trump win. I don't think Powell wants that.
I hope not, personally, but that's another matter. The fact of the matter is this bill not only increases the deficit, war funding is still in play, waste, fraud, and abuse is still in play. So we're not getting any healthier. So the value of collateral, which is in fact the treasuries, which backstops the dollar, are both still falling. And the duration grab is the most important thing. So financing all of this fiscal spending is with shorter duration, not longer duration, which would lift the long end. Yields are not allowed to go up because Trump wants to run the economy hot. Instead, he wants to browbeat Powell into cutting so that the interest on this rising debt is lower. But it's also, wait a minute, you're raising the debt. Even if you lower the interest rates, you're still paying $3 extra trillion, over the next few years. The point is, it's not really good math as it relates to what happens to the value of the term premium that is demanded for holding these bonds. There is a huge supply. So they can invent lots of ways to absorb demand for sure. Bank stuffing, the SLR, we talk about this, different methods. But ultimately, it's not helping the this situation. It only makes it worse. The only way is to inflate out of it. High tariffs is actually part and parcel of this kind of plan, but they're not doing any of the fiscal restructuring that was originally offered. So I think we will see higher yields, which is not consensus. To answer your point, it's going to trigger some confidence crisis at some point. It's not right now. Just like we had in April, where yields spiked higher in 4.5 days from 3.9 to 4.5% in the 10-year, and everything stopped. Equities crashed, credit spreads blew out, VIX went to 60. Okay, then he came in and said, okay, I heard you, bond market. Let's just roll those tariffs out 90 days and give you a little breathing room. That's exactly what happened. And then the steepener turned into a flattener, and that's where we've been for 90 days. So
Because
it'll steepen again.
he wants people to be rich, Samantha. Everyone got thrown for a complete loop because it looked like he was intent on destroying the global economy. It was a complete 180 from what people had hoped for. And then, and I don't think that was his intention, now he's back to Trump wants everyone to be rich. He wants to be rich. He wants his family to be rich. He wants all his friends to be rich. He wants the market to keep going up. He wants the usual, which is asset holders getting rich. Now, I agree with you at some point, and somebody asked that in the chat. They said, how long can we be bullish? I don't know. That is the $1 million
That's the definition
question.
of a bubble. I actually love this. Mike, I quoted him in a write-up.
You're going to party like it's 1999 until things get ugly. So,
Basically,
yeah.
that was the title of my thing, right? We're speculating like it's 2021, but also this is a bubble, and everything about it is to make the bubble. Rate cuts won't help except to maybe fuel the equity bubble even higher. And then Harknet, that was it, from Bank of America, came out and said, we've got the BBB bill, which is going to form a BBB bubble. Anyway, long story short, we have bond vigilantes that will come back in and hammer down bonds when we get the next hint of a failed auction, when we get, again, data that shows jobless claims rising, corporate margins shrinking, not expanding, because that is a definition right there of, ooh, we got some inflation coming in. They can't actually, price over volume. They can't manage their margins. We will have an inflation and or growth scare again, and we'll see what they throw at it to try and tap it down. But we don't have that in front of us to trade. We have a market of grift. We have a market that is clearly expected to rise, and we have to wait for a macro trigger and basically Trump to trip up for us to get a really solid reversal short. And I'll see it. I'll see it in the selling underneath the surface. I saw it in December. I saw it February 19th before we rolled over on the 19th and then crashed. I'll see it in my breadth indicators. At least I feel confident that I will see it. I don't see it right now. Okay, that's it. Main Street, good luck, okay? I appreciate everybody coming back after this little, holiday break. And that's it. I don't know. We'll be back next Wednesday. What else is going on? Really not a lot, right? We have CPI. I'm not too worried about that. That was a question somewhere.
Next week's a little more data heavy, isn't it, Samantha? I think we've got a couple more things. I think there's a bit more to sink our teeth into next week in terms of data, which is
July 20th, Japanese elections. Nobody's paying attention to that. In fact, I just wrote about that last night for clients. So that'll be an event risk if they're not so happy about paying, double for their rice and they vote some folks out. And we'll talk about it then. Okay. Cheers, everybody. Have a great week. Bye.
Cheers, everyone. Thanks, Samantha. Thanks, everyone.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.